Alrighty, what is going on, everybody? Welcome back to another CYPRX video breakdown. In today's video, we're going to be doing a weekly highlight from last week, why the digital asset space flipped bullish, taking a look at some different contributing factors that created a risk on market environment. We're going to be doing a forward looking projection into what to expect possibly on the forefront for next week via the major decisions that we have from multiple central banks coming up. So with that being said, if you enjoy fundamental breakdowns like this, do me a favor, smash that thumbs up button and subscribe. I'm going to just be recording this raw, reading a fundamental report and a digest that we deliver to our private CYPRX community members. As you can see, there are some current CYPRX members actively reading the report right now. We hand deliver these reports and type them out every single evening for our private members to keep them accurately up to date with ongoing things that are happening, not only in the digital asset landscape, but also in the forex and futures markets. So with that being said, let's dive in. Remember, this is a more mature approach. This is an educational video breakdown, and this is for individuals that actually want to learn and digest the markets in which they are currently operating in. This is not bullish moonboy hopium. This is an actual digest of what moved price action last week, why we saw a risk on market sentiment, why, for example, Bitcoin hit $60,000 and XRP rallied to about 59 cents. Digital assets like soy rallied all the way above $1, so on and so forth. Really diving into some perspectives from the fundamental side of things. So let's jump in. We're just going to touch on some of the weekly highlights. I'll skip over the Forex highlights because this is predominantly going to be focused on the digital asset landscape, but we called some significant buying opportunities out on GBP USD. We'll skip over that. I want to focus your attention on a significant call out that we made in the digital asset space, where I said, we highlighted soy as a buying opportunity in the private CYPRX Discord because I'm always giving the private community members what it is that I'm looking for in the markets and where I'm personally dollar cost averaging in, showing them how I've built a multiple six-figure portfolio over the past consecutive couple of years, how just by, implementing capital in at lower prices has significantly increased my portfolio's valuation over the past consecutive couple of years, showing them firsthand how I'm doing that. So I mentioned a buying opportunity at 50 cents on August 3rd or below 50 cents on August 3rd. And just 2 days later on August 5th, this is a couple of weeks back, the price on the digital asset soy briefly dipped below 50 cents, triggering buy limits. And you can see here's the screenshot from within our private CYPRX community, Saturday, August 3rd, where I hand deliver all of my dollar cost average positions on certain digital assets in my portfolio. You can see here I said soy, anything below 65 cents, preferably I would like to see price below 50 cents. Here is that active date on the 3rd when I sent that price action analysis. And you can see on August 5th, we briefly dipped below 50 cents, triggering my buy limits. And since then, this past week, since we're doing a weekly review, soy rallied all the way above $1.02, which was phenomenal to see. Some nice price appreciation in the short term in my personal portfolio. Now, this is so significant because if you look at the crypto landscape amongst retail investors and where their focus was this week, what did you see announced by a lot of the mainstream XRP enthusiasts in the space? Grayscale's announcement of the trust for the digital asset XRP, right? A lot of people miss this because at the same exact time that Grayscale announced an XRP trust, they also announced a soy trust, which you can see here is from Grayscale. This is their X profile, and it says Grayscale Soy Trust is open to eligible accredited investors seeking exposure to soy. So soy, in my personal opinion, is a massive opportunity. Not financial advice. I think it's going to perform very well in the next bull market cycle. And it's just interesting that a lot of people were so fixated on XRP going above $1 because of this announcement, where XRP and soy were both operating at around the same price just a couple of weeks ago at the beginning of August at roughly around 50 cents. And soy is actually the one currently now trading above $1. Not saying that XRP won't in the near future. I hope it does. I hold a significant bag, but this just goes to show why it's so important to diversify and not be so fixated on one digital asset. Okay. So I do hold a very big bag of soy. Again, not financial advice. Do your own personal research. Moving on. So again, these examples just highlight our private community's pinpoint accuracy across multiple different trading pairs, both Forex, futures, and cryptos markets. So Let's move on. In previous videos, I mentioned that I would be taking advantage of discounted opportunities, always trying to keep you all, my followers, at the forefront of what's happening via the technological transformation and what's happening long term. Since this particular video breakdown that I released a couple days back on the YouTube, we have seen a rally in risk on sentiment, reinforcing my ongoing thesis that whenever presented with discounted opportunities, I will continue to capitalize on them while maintaining a long term bullish outlook. With my realistic bullish perspective aligning with some of the largest players in the industry who expect digital asset prices to be significantly higher this time next year, right? So, my personal outlook is that by around this time, ending summer, heading into fall/winter next year, the vast amount of these digital assets are going to be significantly higher than the current valuations in which they're holding today. Again, not financial advice, do your own personal research. And in this report to our private community members, which I will drop on my X profile for you guys to read, there are clickable links. All these links are clickable. So all of the videos and all of the fundamentals that I have attached to this, the private members can click this, and so can you, because I will make this report public. So let's just go over the weekly review, right? Let's jump into this, really digest this, and understand. Again, smash that thumbs up button and subscribe, especially if you saw previous video breakdowns of me telling you guys just a couple days ago when the market was hovering at around $1.9 trillion, where we currently sit now is above 2 trillion, to be taking advantage of opportunities. Not financial advice. Again, I mentioned I was. This past week, the total cryptocurrency market cap regained over $172 billion in value, briefly peaking above the $2 trillion mark before experiencing a slight pullback to end the week. Despite this, the overall risk sentiment remains risk on as of time of writing this and recording this particular video breakdown. That obviously, of course, could change in the next consecutive couple of days, which we will go over. So let's review the key drivers of this recovery and look ahead to next week's potential market moving events. And as you can see here in the screenshot of the total cryptocurrency market cap, we had a weekly low of roughly about 1.9 trillion, which is when I released that video to you guys to say, take advantage of discounted opportunities. We broke above the previous weekly high, and we currently operate about 2.052 trillion as of time of recording this video breakdown. Now, our primary focus last week was inflation data from both the US and the Japanese forefront with the release of the CPI and PPI figures, as well as the European Central Bank's ECB interest rate decision. Global stock markets were mostly positive, buoyed by optimism surrounding potential central bank rate cuts, particularly in Europe, where the ECB's second rate cut of the year spurred a market rally. And then we're going to go over that briefly. So we're going to talk about Europe, we're going to talk about the US, and we're going to talk about Japan. So, and again, remember, ladies and gentlemen, we do appreciate the love and support. If you would smash that thumbs up button and subscribe if you're not already. Going over these digests and actually paying attention to the information that really moves price action and really sways investor sentiment, this stuff is extremely important. If you don't believe me, go ask any accredited investor. They are paying attention to this stuff. You go read any major bank or financial institution quarterly or weekly or annual report, they are talking about this stuff. It is extremely imperative for you to pay attention to what we discuss here in these fundamentals and not just always being so fixated on bullish moon boy hopium. Okay, so on the European front, the European stock markets rebounded after an early weekly loss, which was driven by the ECB's widely anticipated rate cut, which was delivered on Thursday. Major indices like the Euro Stock 600, the DAX, the CAC 40, and the FTSE 100 ended the week on a positive note. The ECB's decision, while slightly downgrading the economic outlook, fueled optimism, although the central bank emphasized that future rate cut decisions would be data dependent. The likelihood of further rate cuts, especially in November, currently remains on the table, though no pre-commitment has been made. And here is that fundamental digest that you guys can go and read if you choose to do so. On the United States forefront, August inflation came in at its lowest level since February 2021, with the Consumer Price Index, or the CPI, rising 0.2% for the month, meeting market expectations. The year-over-year inflation rate decreased to 2.5%, which was slightly below the forecasted rate at 2.6%. However, core CPI, which excludes volatile food and energy prices, showed a slightly higher than expected monthly increase of 0.3%, holding steady at 3.2% year over year on an annual basis. Headline CPI inflation actually decreased, like I mentioned, to 2.5%, while the core held at 3.2%. So the producer price index, a measure of final demand in goods, now we're moving into the PPI, and services costs that producers received increased to 0.2% on the month, where the Bureau of Labor Statistics said on Thursday it matched the Dow Jones consensus estimate excluding food and energy, and the PPI increased to 0.3%, slightly hotter than the previous reading at 0.2% in the consensus estimate. The core increase was the same when excluding trading services, and on a 12-month basis, headline PPI rose to 1.7%, again excluding food and energy and trade, and the annual rate was 3.3%. I know that this is a lot of percentages, and most people that don't understand this stuff are like, what the heck? But let's break this down and let's just talk about this. So, at the end of the day, neither report is expected to keep the Fed from lowering benchmark interest rates by a quarter percentage point when its 2 day policy meeting concludes on Wednesday this upcoming week. So, right now, rate cut expectations are still on the forefront, which has been driving risk asset optimism. The central bank's key overnight borrowing rate is currently targeted in range between 5.25% and 5.5%. So the market is expecting a rate cut of either 25 to 50 basis points at this week's upcoming meeting. With the PPI basically repeating yesterday's CPI reading, this is again a report from last Friday, and jobless claims in line with expectations, the decks have been cleared for the Fed to kick off rate cut cycling, said Chris Larkin, managing director of trading and investing for E-Trade from Morgan Stanley. The markets are anticipating an initial 0.25% cut, but the discussion will soon turn to how far and fast the Fed is likely to trim rates over time. So right now, from the ECB, we saw rate cuts. From the Federal Reserve, we're seeing the market expect rate cuts at this next upcoming meeting on Wednesday. And then now let's roll over into the Japanese front, because in my personal opinion, this is one of the largest contributors to the risk on market sentiment this past week. All right. So, Japan's producer price index, or the PPI, also came in lower than forecast, reducing the likelihood of further rate hikes from the Bank of Japan. This decrease in PPI, coupled with comments from key policymakers favoring low interest rates, has eased fears of further unwinding of the yen carry trade, which we have talked about in previous video breakdowns, and which had previously exerted negative pressure on global risk assets, including stocks and cryptocurrencies. On Friday in the US, on Saturday in Japan, I'm just going to call this lady ST, Japan's minister in charge of economic security and a leading candidate in the ruling party's leadership race, said on Saturday the central bank should maintain ultra low interest rates to support the fragile economic recovery. Frankly, it was too early, she told a news conference gathering the 9 candidates running in the race when asked about the Bank of Japan's interest rate hikes this year. Interest rates ought to be kept low, said T, who is emerging as a strong candidate for the leadership of the Liberal Democratic Party. T's remarks following those she made on her personal YouTube channel on Friday, stressing the need to maintain fiscal and monetary support for the economy. Now, the Bank of Japan ditched negative interest rates in March and raised short-term rates to 0.25% in July on the view that the economy was making progress towards durably achieving its 2% inflation target. Now, we know that on the 31st of July, when the Bank of Japan hiked rates, this negatively affected risk assets globally with stocks and crypto due to the massive unwinding of the yen carry trade, which we have also talked about in previous YouTube videos. So make sure that you scroll back a couple of videos from the beginning of August and you rewatch those fundamental digests, because we broke this down in detail. And you can see, looking at the total cryptocurrency market cap, this is a screenshot from back on July 31st, 2024, when the Bank of Japan hiked rates, how negatively that impacted risk assets, particularly like crypto, where the crypto market sold off from $2.3 trillion all the way down to $1.7 trillion. That is a massive depreciation of price in those short couple of days that we experienced back at the end of July, beginning of August. All right. So if you're not too familiar, we'll just briefly cover this. The yen carry trade refers to a popular investment strategy where investors borrow money in a low interest currency, such as the Japanese yen, which has been in a low interest rate environment for years, and then invest in higher yielding assets in other currencies. For years, Japan has maintained ultra low interest rates, making the yen an attractive funding currency for this strategy. When the Bank of Japan hiked rates back on July 31st, it caused disruptions in this currency trade, in this carry trade. Higher interest rates in Japan increased the cost of borrowing yen, leading to an unwinding of the trade, where investors sold off riskier assets like stocks and crypto to pay back their yen loans. This sudden shift in capital caused global risk assets to decline significantly as investors rebalanced their portfolios. And here's again a clickable article where you can read more in detail. Now, let's discuss this because this upcoming week, this stuff is extremely important because, again, we're going to go over this. But let's say the Bank of Japan decided to hike rates again this week. It would most likely lead to another sell off in risk assets. So we need to be paying attention to these fundamentals moving forward. Again, I cannot stress enough. This stuff is imperative that you learn so that way you gain an edge in the market. When's the proper time to be buying? When's the proper time to be selling? So on and so forth. You don't want to be operating in an environment, especially like crypto, without at least briefly understanding these things or subscribing to a platform like ours that does. All right. So, the combination of lower inflation expectations of rate cuts and softening central bank stances supported risk assets throughout this past week. In the US, technology stocks and small cap companies outperformed, boosted by the promising outlook of reduced interest rates. The softer US dollar and falling treasury yields also contributed to the surge in gold prices, which last week hit a new record high. On Friday, U.S. consumer confidence also improved with the University of Michigan's Consumer Sentiment Index rising to 69, above market expectations, which slightly alleviated the recessionary fears. This improvement in sentiment further buoyed risk assets, while the dollar continued to face selling pressure amid rising odds of significant rate cuts by the Federal Reserve at this upcoming meeting. By the week's end, this is Friday, the market had priced in as much as 125 basis points of easing by the year end and up to 250 basis points over the next 12 months. This came after an article from the Wall Street Journal's Nick T, nicknamed Nicky Leaks, for his excellent sources and inside of the Fed, suggesting that the size of rate cuts was still up for debate. So this again boosted risk sentiment. So the key takeaways from this report and just moving forward. The focus will remain on central bank and economic data, particularly US inflation and employment figures. The crypto market is likely to track these developments closely moving forward, which you can see from our previous breakdowns of why it's so imperative that you pay attention to this stuff. With the broader risk sentiment currently dictating short-term price movements, with the potential for no further rate hikes from the Bank of Japan at their next meeting and further rate cuts in both Europe and the US, along with the Bank of England, the outlook for risk assets, including cryptocurrency, remains positive for now. The volatility is likely to persist. So let's just briefly touch on the forward trajectory for next week and go over some scenarios, scenario 1 and 2. So, scenario 1, looking ahead into next week. We have key monetary policy decisions from the Bank of England, the Federal Reserve, and the Bank of Japan. And in my view, the most favorable scenario, so this will be scenario number 1, for a continued risk on market sentiment. That means we continue higher above the $2 trillion range, correcting more of that previous downside move from the end of July, beginning of August, where we sold off, which I just showed you guys, from roughly about 2.3 trillion all the way down into 1.7. If we want to see further bullish optimism in risk assets, we need to see these things. And again, my personal opinion, that favorable environment would occur if this upcoming week we see the Bank of England either cut rates or hold them steady while signaling that future rate cuts are still on the table. Number 2, the Fed delivers a 50 basis point rate cut. Number 3, the Bank of Japan holds rates without any further hikes. This combination, in my personal opinion, again, could fuel risk on market environments because lower or stable interest rates from these major central banks generally make borrowing more cheaper, encouraging investments in riskier assets like stocks and crypto. Additionally, dovish guidance or hints of future cuts would signal ongoing monetary policy support, boosting market confidence and risk appetite. For the Bank of Japan, maintaining its current rates without hikes would also keep the cost of borrowing yen low, reducing the pressure to unwind the yen carry trade any further, which could otherwise, again, if it does unfold, weigh on global markets like it did back on July 31st, rolling into August. On the other hand, this is scenario number 2, and this would be negative, in my personal opinion, for risk assets if we saw these things play out this upcoming week. So I said, on the other hand, if central banks push back on rate cuts, we could see more risk off scenario unfold. For instance, number one, if the Bank of England holds rates and signals fewer cuts this year. Number two, this would be extremely bad for risk assets, in my personal opinion, where we would see a sell off in both stocks and crypto, is if the Fed decides not to cut rates at all at this next meeting on Wednesday. Maybe they surprise the market considering the fact that most market participants are expecting a 25 to 50 basis point cut if they come out on Wednesday deciding to hold rates and keep rates higher for longer, mentioning that they're not ready right now to cut rates because of the current data situation. And then number three, the Bank of Japan, at the same time the Fed announced that and the Bank of England announced that, the Bank of Japan announced another rate hike. This would further unwind the yen carry trade, strengthen the yen, and weigh on risk assets, in my personal opinion. This more hawkish stance would most likely weigh heavily on risk assets because it signals tighter monetary policy conditions for longer. Higher rates or fewer rate cuts reduce liquidity, making borrowing more expensive and less attractive. In this case, the Bank of Japan and another rate hike, in this case, the Bank of Japan, another rate hike would likely accelerate the unwinding of the carry trade, which I mentioned, leading to a broader sell-off in risk assets as investors shift towards safer investments like bonds in the US dollar, along with the Japanese yen. All right. So all of this in mind, I know that this was a 22 long minute breakdown, but at the end of the day, this stuff is super important to pay attention to. If you made it to the end of this video, you guys now know what you should be paying attention to next week to see a continued risk on sentiment. That means if we want to see the prices of digital assets across the board continue above $2 trillion, we need to see those certain factors play out. And if not, and we see the opposite side of the spectrum play out, be prepared for another market downturn because that's most likely what is going to happen. So now that you guys are ready for that next week, I hope that you all enjoyed this breakdown. I know I stumbled on my words a couple of times. It is what it is. I was trying to get this video out of the way for you all. It is the weekend. So as always, you guys enjoy the rest of your weekend. Many blessings to you all. Be cognizant, be aware out there. And I cannot stress enough, now is the time for education. Now is the time to pay attention to reports like this so that way you understand what is happening, why your portfolio is bullish one week, why it's not the next week, so that way you understand in the moment what's happening so you do not get shaken out. Do not lose sight of the long-term vision and understand that this time next year, the most likely scenario is that risk assets across the board, including crypto, are going to be significantly higher than what they are now. As always, with that being said, smash that thumbs up button and subscribe, and I will see you guys in the next video breakdown.